Welcome to our Financial Literacy Education series, where we cover a range of topics to help you better understand your money, to help you become more engaged with your money, and to help you make better decisions about your money. My name is Corin Jacker. I'm from Priority One Wealth Management Group. In today's episode, we're going to be focusing our attention again on wealth creation. To summarise, there are four broad concepts of wealth creation: investing and saving in your own name, debt reduction, superannuation, and gearing. Today we're going to focus on gearing. I encourage you to go and have a look at the other episodes we've created to cover the other areas of wealth creation, and importantly, visit the episode on cash flow and budgeting, because it's really important to understand what income you're earning, what you're spending, because you need to identify surplus cash flow, surplus income that can be put towards wealth creation concepts. So that's important to get right first before we can look at any of these concepts. So let's look at gearing. What is gearing? Gearing is simply borrowing to invest. And there's many different types of gearing. So you could have some shares, for example, and you could borrow against those shares and buy more shares, and that's typically a margin loan. There are some products that are manufactured around that, such as installment gearing or protected equities. But the one we're going to focus on today is what most people are more familiar with, and that's home equity lending. So that's borrowing money against your own home. But let's first look at why we want to gear. So borrowing money and buying something just enables us to allow us to have that investment sooner. So if you were wanting to buy your own home, if you didn't borrow for that and you wanted to save up for all of it, you could be saving for many years, if not decades. So it gets you into that investment sooner. Can obviously then also enable you to buy more investment than you otherwise would have been able to buy with just your own money. It can help improve the quality of your portfolio. So if you have shares or you have property, by borrowing money and buying other shares or other property, you can increase the diversification of your portfolio and you can increase the quality. It does open up investment opportunities which otherwise you wouldn't be able to consider. Again, if you had your own home and you wanted to buy an investment property and you're just going to use your own savings to do that, it'd take you a lot longer to be able to do it. The main reason why a lot of people are attracted to gearing from the investment point of view is it's a very tax-effective way that can be used to invest. And it can also help reach our goals sooner. And the reason for that is because it's a leverage effect by enabling us to make an income and a return on more assets than we would have otherwise been able to do, which means we're going to create more wealth quicker. So when we talk about home equity, what we're really doing there is we're saying that somebody's got their own home, they've paid off their loan or they've paid off a lot of their loan and they've got equity in their home that they can borrow against. Typically they can borrow at those lower home loan rates compared to other forms of lending. It can be a tax-effective way, particularly if you still have a mortgage, it can be a tax-effective way to help pay off that mortgage sooner. And the interest on the money that you borrow to invest is typically tax deductible. And the way it helps us pay off the mortgage sooner is if we go and get an investment loan. The interest on that is tax deductible. So the cost of that interest is lower to you than the mortgage rate. The mortgage rate is non-deductible, which means you are earning income, you pay tax, then you have to pay the interest with that after-tax money. So the effective cost to you is higher than the interest that you're getting a tax deduction on. The other benefit though is you've now got another source of income coming to the house. So if you buy a property, you've got a tenant paying the rent, and you can focus that rent to be paid off your mortgage first. So what we do in this case is we focus on putting all the income we've got into paying off the bad debt, the non-deductible debt, the home loan debt. And we typically probably pay interest only or very small amounts of principal on the investment related debt. But let's look at an example of what gearing is as a concept. So if I have my own money, I've got $50,000 and I invest that and it makes a 10% return, I make $5,000 on my investment. But if I go and borrow $100,000 against that and invest $150,000, and if I still make 10%, I've made $15,000 on the total investment, which on my $50,000 outlay, I've actually made a 30% return instead of a 10% return without gearing. That's that leverage effect. So it enhances the returns you could get on your own money. Let's look at a typical example of buying a small investment property. So in this case, we're buying a property for $420,000. We've got costs of buying the property, so our total outlay in this case is $72,000, which could be a cash outlay, or we could be using the equity we've got in our own home to fund that as well. In this case, the numbers work out that if we get a 4% rental income, so about $330 a week, the weekly out of pocket in this example is about $100 a week. So it's not a huge cash flow outlay. And in fact, depending on the property you buy, if you get a property that has stamp duty exemptions, or if you get a property that has bigger depreciation, or if you pay interest only on the loan, the weekly out of pocket could be a lot less. And in fact, it's not that difficult in the current environment with low interest rates, with a half decent rental yield, to actually be cash flow positive from day one. So the actual cash outlay in buying a property at the moment can be quite low. But that doesn't mean it's necessarily a guaranteed way of making money. Because gearing is a double-edged sword. And what I mean by that is that it magnifies the gains. So in this example, I've got $20,000, I borrow $180,000, I invest $200,000, I make 10% on my investment. So I've actually made $20,000. So on my own $20,000 outlay, I've made 100%. But if I lose 10% on my investment, so now my investment's only worth $180,000, I've lost $20,000. I've lost 100% of the money I put into the investment in the first place. That's what we mean by that double-edged sword. It magnifies the gains if the investment makes money, and it magnifies the losses. So it's a higher risk strategy than much of our other wealth creation strategies that we talk about in other episodes. So some key principles that we need to stick to when looking at borrowing to invest or gearing. The first thing, you need to have regular, steady, secure cash flow. So you need to make an assessment about your income security and your job security. And it may not be your actual job security as such, but you might need to ask yourself the question, if I lose this job, can I replace my level of income relatively quickly? And if the answer is no, then you need to think twice about going and borrowing more money. And the reason for that is we need to be prepared to put in more funds if things go wrong. So if a tenant is out of the property for longer periods of time, if there's damage done to the property, it needs significant repairs and maintenance, we need regular cash flow to keep funding the loan whilst we don't have that tenant support. We also need a buffer. So if you spend every spare cent you've got buying an investment property, it's probably inappropriate, because you want to make sure you've got access to capital on top of what you're buying, just in case if things go wrong again, you've got money to contribute, which means you're not in a position where you could potentially be forced to sell at a bad time. You need to make sure you're protecting the strategy. And what we mean by there is from a general insurance perspective. You want to make sure you've got the property covered, contents covered. If there's tenants in there, you want to make sure you've got appropriate tenants insurance. Then on a life insurance and a personal insurance perspective, if you're taking on further debt, you need to probably review how much life insurance you've got, total and permanent disablement insurance you've got, or income protection and trauma insurance you've got. And we'll cover off all those personal insurance topics in another episode. It's important to do your planning and your projections conservatively. And why I say that is because it's not very hard for people with vested interests in you buying a property to show you what looks a very attractive option in the next 10 or 20 years. It's not that difficult to say, here's a projection of what your property will look like, very little cash outlay. It's going to have this wonderful capital growth and it's going to make you lots and lots of money. And if you have that example and you then buy another property in 2 or 3 years' time, and another one after that, you'll have this magnificent wealth creation. What we like to do in those examples though is let's look at a few worst case scenarios. What happens if interest rates go up significantly? What happens if you're without a tenant for significant periods of time? What happens if there is a significant reduction in property values in the short to medium term? Can you still weather the storm and hold on to this strategy? And if you can, and it still adds up and it still makes sense, and you've still protected yourself and you've still looked at things conservatively, and it still looks like it's going to work, then it could be a suitable option for you to consider. Because you need to make sure finally with all this, you need to have that time frame. So if there is a market downturn in the next 3 to 5 years of property, you don't want to be looking at buying a property today with the aim of selling it in a couple of years' time. You really need to have in mind that you're going to be holding it for 10, 15 or 20 years' time. In our final episode on wealth creation, what we're going to do is actually look at gearing of what we looked at today and combining it with superannuation. So looking at buying a property within superannuation or a self-managed super fund particularly. So don't forget to have a look at our other episodes of wealth creation, of saving and invest in your own name, debt reduction, superannuation, borrowing to invest or gearing, which we covered today. And in our final episode on wealth creation, we'll be looking at combining the two concepts of superannuation and gearing together. Thank you and goodbye.